The market is super uncertain about what the next move is going to be. We talked about it in last week's video about the US debt ceiling, about the government not coming to terms in order to raise it so that they could pay off their debts. Obviously, we saw a little bit this week that they pushed that problem down the road. We talked about it in last week's video, so make sure to go check that out if you haven't already. In terms of this will be solved. It could be a great buying opportunity. We saw the market come about 1 to 2% off its lows this week, but then all of a sudden the market kind of stalled out and they were waiting for the jobs report. So we'll be going through the US jobs report and breaking it down, and we'll be covering at the end what I think is the real metric heading into earnings season. So stay tuned for that. But if this is your first time here, my name's Nick. Welcome to Waste to Wealth. I have a huge favor, a huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I would definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. We head into the computer, just taking a look at the S&P's choppiness over the past month. Obviously here on a little bit of a downtrend. So the video that we put out last week, we saw the market was trending around 4,300, took a little bit of a dip, and then off the dip comes up and it was up about 2.1% on the week. So kind of stalls out here while they're waiting for the employment report. So the employment report comes out on Friday and it is a huge disappointment. So let's break it down, take a little look into here. And we see September's job creation comes up short with just a gain of 194,000 jobs. The Dow had predicted that the jobs report was going to bring in 500,000 jobs. This is an absolutely huge miss. We do see, on the other hand, that the unemployment rate fell to 4.8%. That's better than what they were expecting at the 5.1% range. But we see this job growth continue to drop down on this chart here, obviously not including total non-farm payrolls. It is important to note here that the biggest decline was in government payrolls, while private payrolls increased by 317,000. Okay, so let's take a look at what Nick Bunker has to say. He said, "This is quite a deflating report. This year has been one of the false dawns for the labor market. Demand for workers is strong and millions of people want to return to work, but the employment growth has yet to find its footing." Now, we see here, obviously, unemployment rate is going down. This is a very good sign, especially coming off the peaks of 14.8%, kind of in the heat of the pandemic. But we also found another stat, and this one is absolutely blowing my mind. So we'll take a look at this chart right here. And this was somebody by the name of Charlie Belilo on Twitter. Go follow him if you want. But this is the US job openings. How many jobs are open in the market? And you can see this number is absolutely out of this world. It's 3.3 million job availabilities right now in the US. This is the highest that it's ever been, but yet the jobs report is absolutely brutal. We need to find ways to get those unemployed into those jobs. And we kind of saw from the market that they kind of took this news. They didn't really react too much to this news. They were like, okay, we didn't really see a sell-off there. So there must be a better indicator that we can look at, because we see, okay, there are a lot of unemployed people, 4.8% unemployment rate, still not bad, but relatively high in retrospect to the past couple of years. But we also see the most amount of jobs ever open and available for working right now in the US. Granted, we don't know the level of worker that's required there, but I think there's something deeper rooted that could cause the market to panic. I don't think it's in the unemployment report, the employment report, whatever you want to call it. It's earnings season. I think that the biggest watch over the next couple weeks is going to be how the big tech companies perform. especially since they make up such a huge percent of the S&P, of the NASDAQ. If there is any panic, these are the only companies that have really been up over the past couple of weeks. So when we talk about market breadth, it's how much of the market is winning. And these companies are the ones that are winning the most. It's not a great sign of a healthy, economy, a healthy stock market. But let's take a look at what I found here on Zero Hedge in regards to what the earnings expectations are for Q3. So again, like I mentioned here, the big boys, they add up the S&P 500 weightings. Apple is 6% of the S&P, Microsoft 5.8, Google 4.3, Amazon 3.8, Facebook 2.1%. That is a 22% of the 500 companies, 500 odd that are in the S&P 500. That is absolutely massive, especially if there is any ripples. So what Zero Hedge has compiled here is they put together what the original analyst expectations are of what Q3 looks like on an earnings perspective. And then they also look at what the last 60 days looks like if there was any changes. And then they also show the 30-day. So let's just take a look here. So the analysts expect $1.23 per share. It's up a cent over the last 60 days, but it's flat over the last 30 for Apple. Surprising, since the supply chain worries are the biggest concern. We did talk about that a couple weeks back in terms of not having the product to sell. So I'm surprised that Apple is kind of trend in the stable to flat area. We also have here Microsoft. It's $2.07. It's up 1 cent over the last 60 days, but it's flat over the last 30. Google, $23.40. It's up 7% over the last 60, but it gave it back in the past 30. So we have Amazon here at $8.92. And this one is taking the biggest beating over the past 60 days. Analyst expectations are that it's going to come in at less than $4 or around that $4 mark. It's since decreased in the past 30. Facebook up, obviously with advertising, shouldn't be impacted too much when it comes to the supply chain congestions. This article is alluding to the fact, they go on to say that they're basically setting them up so that they outperform and they actually go on and have an absolutely great quarter. They take a look at the previous Q2's earnings of this year, and they also look at Q3's of last. So it's definitely one that they think that these companies will definitely be the leader. And I've always been a big proponent that these companies are making money hand over fist. We see that in the earnings per share numbers that we just discussed right now. Okay, they're going to take a little bit of a hit, but at the end of the day, you want to be, with the horses that are kind of leading the race, especially in a time that's uncertain. So this is kind of the metric that I'm watching over the earnings period. I took a look at what earnings dates are confirmed as of today. It is Friday as I film this. And for the biggest ones, in terms of the biggest leaders, we have Alphabet, aka Google. They're going to report on October 26th. You have Facebook here on October 25th. And then you have Apple here, and that's going to be on October 28th. That's what I can see so far. So that third week in October is going to be the big week, the D-Day in terms of where this market goes. Are we heading for higher highs? Or are we going to hit in this stable / flat to down period over the next couple months, or however long it's going to take us to get back? But let me know down below what you think. Earnings season, are these companies going to smash, or are these companies going to be hurt by the supply chain and by the current economic conditions? If you're still with me, please do me a huge favor. Hit that like button, especially if you got any value out of this video. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on. I hope you all have a great week in the markets. Happy trading.